Our core mission has always been to develop connections and deliver industry content between like-minded individuals, and for now, we have reinvented the way to facilitate this for our community through these online discussions. So what we have here for you today, I'm joined by a panel of thought leaders who are going to speak from their own point of view regarding the future of the industry. A few housekeeping notes for our viewers before we turn to our panel. All viewers are now on mute, and in the footer, if you move your mouse, you will see a Q&A dialog box. You can submit questions to the panel, and towards the end of the session, we will address some of those questions. So please feel free to shoot them out. So without further ado, I would like to introduce and welcome our panel and the moderator, DJ Van Kuren, Managing Partner and Co-Founder at Evergreen Property Partners. DJ, on to you.
Thank you very much, Marina. I appreciate it. So welcome today. We're going to be discussing an area that I think a lot of people want to know about what families are doing based upon COVID. Myself, I'm the managing partner, as Marina said, with Evergreen Property Partners. That's a newly formed entity, specifically where we work with a number of various families. My background includes working directly for the Heyman family of Giorgio Perfume, Giorgio Beverly Hills, and also with the third gen Montforts. They own the Colorado Rockies, and right now we're doing some work with the Marriott family as well. So thanks so much for being on the panel today and the call that we have. I do a little bit different, go about things a little bit different when it comes to asking questions. I don't like to wait to the end. I like to actually have participants and people that are listening in participate and sort of drive the conversation. So if you have any questions from something that Kent says, David says, Tom, or myself, then please bring it up and we'll include it within our conversations. So first, I'd like to introduce Kent. Kent, why don't you tell us a little bit about who you are, what area, industry that your wealth was created in your family, and a little bit about your family office.
Sure, thank you. It's a pleasure to be here. Thanks, DJ. So I'm a third generation member of the Swig family, and the Swig family started in business in San Francisco. My grandfather started a company in 1936, actually moved to San Francisco in 1946 from Boston. And primarily our work is real estate, and particularly commercial real estate. We have about 10 million square feet of office space around the country. We're growing in the residential area as well now in multifamily. So we have a portfolio in around the San Francisco Bay Area, looking to grow that. We've got some property in Los Angeles as well. Most of our holdings are in New York City, San Francisco, Los Angeles, Oakland, California. We've got some properties in Texas. We used to own the Fairmont hotels that my grandfather started in 1946, and we have divested of our last hotel about 2 years ago. So it's about the first time in 77, 78 years we haven't been in the hospitality industry, although it seems to be a thankful thing that we're not at the moment. Separately, I've got companies that I own and have a family office for myself and my children, primarily in real estate, although I've been involved in cryptocurrency as of recent, a medical purveying company as of very recently. And then I've got operating companies. I've got a construction company, a real estate brokerage company called Helmsley Spear, a company called Brown Harris Stevens that does third-party brokerage in the residential and management, and Halstead. So I've been creating and buying third-party operating companies and growing those as well.
Great. Tom, a little bit about your family, where the wealth was created, your family office, and a little bit about yourself.
Sure. Well, thanks for having me, DJ. My family, I'm a fifth generation Californian. My great grandfather came over from Spain, was originally a sheep herder, and actually settled on some fairly substantial land holdings in South Monterey County, really the central coast of California. We've since evolved from sheep into a cattle ranching family as of now. Large interest in oil, which was in the late 40s in South Monterey County. Is where a large portion of the wealth was created, and we've since evolved into farm ground, ranching ground, predominantly an ag family. We have a lot of real estate holdings as well, predominantly in California. We do have some holdings outside of California and Texas, but it's been across the board. It's been office, retail, multifamily, Me personally, Ranch Harbor is a firm that I've founded along with some partners of mine. I'm based in Newport Beach, California, and the focus of Ranch Harbor is really it's geared towards family offices, my family included, of course, and seeking out current yield-oriented real estate in the call it $2 to $15 million check size from an equity perspective. So it's really sub-institutional, above the traditional syndicate of just kind of club investing. We really view ourselves as an real estate investment manager that can oversee operating partners in where we're focused in the Western U.S. Across the board, from multifamily to industrial, or the key focuses. But with COVID, it's sort of creating just opportunities that are coming kind of from all angles.
Great. David.
Hi, DJ. Thank you. Thank you for inviting me. So I'm helping Andrew and Peggy Chern, which is CFT Family Trust, to build a real estate portfolio for about 16 years. So naturally started with Penn Express, owning the real estate, instead of leasing it, we kind of stopped buying that like 16 years ago. So now we own about 800 plus locations out of 2,400 operating Penn Express. Those are all corporate stores anyway. So that's pretty much our retail portfolios. We expanded to owning some grocery centers in SoCal, and then we also have a portfolio of office and expanded to residential mixed use. And most recently, actually, on the other side of Canada, and get out of the hotel, we actually get in the hotel 2 years ago. So we have some exposure in the hotel sector as well. So it's a more diversified hotel portfolio, like a real estate portfolio. And in general, we have a long-term view of real estate ownership. So the family trusts have a long-term strategy for owning real estate.
Well, back in, I think it was February or so, we were working on a number of projects, but actually in Texas, and this was with the Montforts, as well as in Denver. And then all of a sudden, COVID comes in. And this is, people say it's a black swan. Some people question, is it really a black swan? Is this something that we've got to live on a go-forward basis? And personally, I started to talk to other families, and I was like, what are you guys doing with this whole thing? And I'm curious, and I'll come back to what I found about it. But Tom, let me start with you. What happened with your family? Did you guys focus in on a specific investment area where you guys were like, okay, we have to focus on this, we have to look at it, rebalance it? Was it across the board? How did you guys react initially when when COVID really came to be something that we saw there's going to be disruption happening as a whole?
Well, I would say the initial reaction was, just look inside at the existing portfolio. And so we were looking at the retail holdings, the office holdings, anything that, sort of we were, dependent on tenants to really understand what we needed to be prepared for. And I think we've been addressing that with our tenant base in terms of deferred rent and really trying to accommodate them as best we can. And also looking towards the regulatory environment to understand, particularly in California, there's been a lot of just legislative actions that have been taking place that really impact landlords. And so we were really keeping our head on a swivel from that perspective to understand what we needed to be prepared for as a land holder. I will tell you, I think what's been most meaningful out of this for our family office, is it really was a catalyst for us to better organize ourselves. So what we have done and what we started doing in late April was we got into doing our family governance, more formalizing our family office from a governance perspective, creating a family constitution. I have 4 older brothers, so we sit in the the 5th generation. My parents are still living, so they're 82 and 80. And we've been now on weekly calls as a family, organizing our governance, and obviously within that, we're talking about investments constantly, but it's really brought us together in a way that we didn't expect. And that's been a real positive for our family on 2 fronts. Socially, of course, we're just together more, and virtually, of course. And then also, I think we're beginning to galvanize in our investment philosophy, in terms of long-term holds, looking at, anything that's generating cash and liquidity, and with an eye on taxes. going forward.
Yeah. I think, that's one of the things that you bring up, and I'll be curious, Ken and David, what, about your family here, but what you brought up, Tom, is something that is definitely happening amongst a lot of different families, where it's made them sit back to sort of look at the overall picture to say, okay, how are we allocated in various investments? How do we have our governance? How have we looked at that? And so, that's definitely, I see as a positive thing from COVID. Kent, what about you? What happened once COVID happened? Did you start looking across the whole portfolio? Was there a specific area that you were focused on? Was it something similar to what Tom said? What about you guys?
For us, we're on a continual basis of working on governance and other documents. So we, in fact, just finished a couple of weeks ago revising our governance document again, which was in process pre-COVID, and then that's a living, breathing constitution. So that works its way through. For us specifically, when the COVID hit, and I'll split up between my family and my businesses. For my family's businesses, I think the number one concern is the health and safety of our tenants and our buildings, right? So we had to have an approach of how to make the buildings safe and secure in this new environment. Secondly, we looked at rent payments, right? What do our tenants need? What can they do? Are they paying, et cetera? So I will say one of we've always tracked rent payments very carefully in our portfolio, but now, the work was very, very specific and much more detailed, contacting every single tenant, finding out how they're doing, what they need, are they able to pay rent? And fortunately, our commercial portfolio, which consists of, larger office buildings, some are, 1.5 million, 2 million square feet. We've been blessed that we've had a pretty good rent collection. Our residential portfolio in San Francisco has been doing well. The retail has been difficult, as you can imagine. So that's working with the tenants. Our Los Angeles portfolio has been doing well. We have one building that's is a lot of medical. That's had some problems because there's no extra or outstanding work that goes on, non-essential medical that's going on, and other than COVID. So that had some issues. In the midst of this, we did a financing in a building in New York City. We bought the former HBO building, leased it to Bank of America for 20 years. We were intending to do it all out of equity. The deal became very good for us, so we decided to put some debt. We were able to close that about 3.5, 4 weeks ago. So in the middle of COVID, there is business and financing going on like that. Separately, I'll tell you, we own a company. I own a company, Holstead Property and Brown Harris Stevens. They are third-party purveyors of property management, brokerage, and other residential services. We had always believed that it was a great idea to have them separately, and it was, one and one made three instead of two. But in this environment, because of some of the duplication in services, we have been vacillating back and forth of whether to merge them in together. For years, we decided we would do it. This would be the right time. So that was a big change in our portfolio, and I think that was COVID generated. So we've merged into Brown Harris Stevens as a name brand. That will take some time, but it's the same ownership and infrastructure with two different names. So that was a change. I own a company, Helmsley Spear. We've been the recipient of many, many, many new brokers because I think we don't have legacy issues where some of the other firms have had some problems. So we've been able to retain and bring on almost 30 new brokers, obviously taking a longer term perspective in the marketplace. So it's been opportunistic on some, and then you're playing defense on others. But we've reverted over to an offensive.
Now that's on the business side, correct?
Yeah.
Okay, so what about on the family office side? Your portfolio, for example, did you guys make any changes? Or were you looking in specific areas as a whole for the family?
No, I mean, we've looked, as I said, we've dug deep to make sure that all of our tenants are in good positions throughout the portfolio across the United States. We have one property, 544,000 square feet in Texas, that it's a single tenant. They're in the retail business, so that's that one we're watching, and we're working with that tenant because that's an issue. I will tell you, we have WeWork at 1460 Broadway in New York City. They take a better part of 200,000 square feet. They've been paying on time and steadily through, and want that building very much. So that's been, you know, a relief for us. But fortunately, we've been in a good position. I will again say the retail is a big issue, and I think landlords have to take a look and reflect on something. You've got a tenant, you know, that's not able to pay rent in many instances, a restaurant or whatever, retail, and then you have to make a choice. Do you swap them out for somebody else to do basically the same thing at a lower rent and start over, or do you work with these tenants and try to help them? We've chosen the latter, although there have been tenants that just said they can't cut it and they've decided to close out. So I think retail is probably one of the bigger you know, problems that are in our portfolio, although not significant, fortunately.
Now, if anybody's got any questions, please put in the Q&A so we can help, you know, get some of these answers for you. We're here for you guys, and we want to make sure that you'll help drive this conversation. David, what about you, and specifically in the family, you know, office, and you know, I know that you focus in on the trust and the real estate and whatnot. Did you hear anything else portfolio wise within the family that any changes were being made or looked at?
Yeah, for us, basically the pandemic, when it hits, we just completely shift almost from like a football game from offense to defense. So it's completely shift. And we have a lot of exposure to retail, and we have some exposure to hotel sectors. And those are the two sectors probably hit the most. And just to give an example, even when it hits, you know, Panda Express had to close the dining room, right, around a lot of places around the country, basically. And even we have a, you know, arm's length deals, right? So even Panda Express will come to stop paying rent, right, to us. And they stop paying rent to everybody, right? So then they make rent relief requests. So we kind of receive tons of rent relief requests from all the retail tenants. And we have one hotel have to close, and we have a lot of hotels running at very, very low occupancy. So you really kind of run into defense mode, because before that, we kind of buying real estate, you know, opening new pandas, we signing new leases, all that. Now you completely is working with existing tenants and find a way to, like Ken do, right? We decide to work with every tenant to try and to make it work for everybody, from landlord side and the tenant side. And we provide some relief, provide some, you know, deferred rent. Some of us will have to provide some abatement to make it work for everybody. But, you know, this is still ongoing. You know, like I said, the closures continue, and LA can go back to stay at home again. So this is a continual effort to almost kind of protect your existing assets. So the teams are shifting from, you know, doing new deals to, you know, working with the existing tenants and working with the lenders and find a way to create, you know, just protect your assets.
So, you know, a lot of the families that I was speaking with, they focused first on their investment portfolio, their stock portfolio. There was a lot of, you know, uncertainty, a lot of fluctuations, ability to make a bunch of profits depending on what you're investing in or even sell. Coincidentally, I also believe that because a lot of profits were being taken off the table from prior investments, that's going to increase opportunity zone investments for family going into next year. However, that was the first area that there was what was I going to say? You know, the focus, and then it was back to real estate to say, okay, what's going on with our real estate portfolio? Is there an opportunity? What are we going to do? So, you know, one of the questions that we have, which I think is great, is that, you know, Kent, you've got a very high focus on real estate, and everybody here, you know, that's their primary area of focus is real estate. And so I want to know from you guys, have you considered diversifying outside of real estate given the market uncertainty?
Well, I will tell you, prior to the COVID, I had worked with my family to diversify, which, you know, which to us was going to residential instead of commercial, which isn't much of a diversification, but we had done that over the past couple of years, and we bought a fairly nice portfolio in San Francisco. We have a building in LA. We are negotiating a contract now still for another nice building in the San Francisco Bay Area. So yes, we were looking to diversify out of just commercial per se. We exited the hospitality industry a couple of years ago. We felt we achieved what we needed to do over a somewhat 70-year period. So I think our timing was good on that. Certainly it had nothing to do with predicting any kind of pandemic. But in terms of opportunity, I will tell you that this is probably one of the greatest times that we've seen for opportunistic investing. It's obviously because there are big problems out there, but you know, the Chinese character of opportunity and crisis
right.
is one and the same. So it's all depending on your perspective. So if you have a clean amount of money or a clean balance sheet or not a lot of problems, I think this is a very, very good opportunity to go into the marketplace selectively and look to do things. And I think one of the tricks for families right now is that we all have our businesses that we're doing. And the idea is to devote enough resources and talent and time to make sure that your existing portfolio or existing investments are doing well and are protected. At the same time, in my opinion, it's very important to shift some of human resources and monetary resources to look for new opportunities.
So are you doing that outside? I mean, have you thought about doing that outside of real estate?
Yeah, for me, I happen to I've done one thing as a result of the pandemic, and another was shifting around. So I've been involved with a cryptocurrency company,
right,
called Dignity that's moving forward and launching and going well, and we've got a mining operation in upstate New York that we mine for Ethereum. We're growing that business. We have a coin, the Dignity coin, that had some problems in its former iteration when I did not own the company. We're now relaunching that and doing well. So, and I think the timing happens to be good in that respect. I got involved in a medical company, purveying company, simply because in March, looking at all the problems and these governments and enterprises that couldn't find any related medical device, medical equipment, and I happen to have a lot of relationships with that. So I've got two sons that are involved in that now, almost full time, and that's working out very well. And we're simply purveying, equipment through the chaos that's there for people that need it, and that's proving to be a very good opportunity.
So really take advantage. You're taking advantage of some of the opportunities that's been created right outside of the real estate, obviously the medical and whatnot, for what you
right
said.
And that's yes.
No, go ahead. Sorry.
I'm good. Let Tom say.
So Tom, let me ask you, you're going through the governance, like you said, which is, the first place that people should really be starting, families, to figure that part out. However, because of I know that you had started building out your real estate platform a while back. Have you looked to diversify into other areas, or has your family since COVID? Yes or no?
Yeah, we have. I mean, we've not acted on anything, but I would say I would come at it from this perspective. I mean, we're looking at it as, to Ken's point about having a clean balance sheet and liquidity available, is looking at it from the view of we view ourselves as rescue capital. So in terms of operating businesses that are, in the need of, whether it's the form of debt or equity financing, where we can be helpful in that regard. And in industries that we like, but I think we certainly are seeing more and more of those sort of opportunities that have just businesses that generally, obviously retail is obvious, and sort of limited service hospitality, which obviously has a retail component to it, but the operational component of it as well. We've looked at opportunities there where we could be of value as a capital provider to sectors outside of real estate, but we have not acted on anything. I will tell you candidly, we continue to stay fairly focused on real estate. general.
So David, I got to ask you and we're going to go around for everybody here. This is the ultimate question that people want to know. Where are you seeing, you've already mentioned, Kent, some of the opportunities that you're seeing that's been created from COVID. David, where are you seeing opportunities in this environment because of COVID?
Well, I think just like I said, the Chinese word is crisis, and opportunity. The second word, I think at this point, we are still focused on the real estate side, dealing with the crisis. So there are opportunities I can see it's coming out, but there's no real good opportunity at this point yet. And to relate to the last question you had, CFT, the Trend Family Trust platform, do have a team of alternative investment. So we are already diversified last few years into non-real estate investment. So we're all looking at opportunities, but at this on real estate side, we haven't seen real good opportunities at this point. So we are more focused on dealing with the crisis in hand.
Got it. What about you, Tom? You got to take off your mic. You're muted.
I got you. Sorry about that. I think I would echo, what David was just mentioning about, opportunities not quite being there yet. I mean, we've been reviewing. We've screened a lot of deal flow in the last 90 days, and it's all kind of fits in the sort of strike zone of what we're looking at. Meaning, it's in that kind of on average about $7 million equity checks. Across over 60 deals that we've screened. But nothing's jumping out at us, with the exception of a couple of multifamily plays that we feel like you can come in on a going-in basis and you can wait to renovate. You can establish some cash flow and in a few years, then stabilize and away you go for a long-term hold. So that's, I think would be generally my comment on what we're seeing currently.
Got it. Well, I can tell you this is that, we're working on a project right now with the Marriott Family Under Stress Hospitality, which is quite interesting. It seems like that has been the primary area that we've seen distress happen. I do think that we're going to continue to see retail and, where there'll be challenges. And of course, on the debt side, I also think that once the stimulus rolls away, and COVID continues on, I thought we'd be done by July or so. I think we're going to start seeing a hit on the workforce housing for multifamily. I think that a lot of the payments that have been coming in have been, it's been artificial because of monies, and the first place that people want to make sure that they keep is the roof over their head. And all these people in workforce housing, the majority of them are working in the retail sectors and working in industries like that, where I think may never open up again. We had a property that we were going to look to. We purchased 3 different properties at the time, and we were going to close down operations, but that happened within the first week of COVID, and they're not going to open up again until probably a couple years. And I think a lot of these small businesses are really going to be hit, and there's not going to be the jobs to go back to. So I think the Class A's and B's, where a lot of people are interested in the multifamily, will continue and maintain. But I think this workforce housing, we are going to see some hits taking place. And I think that the retail side, if they've got smaller retail tenants, I think that's going to be a challenge too. What'd you say, Ken?
I was saying, we're just launching a $250 million fund for residential multifamily. And I agree with you, there's going to be problems there. Obviously, when you've had a major problem with the amount of unemployment that we've had and layoffs that we had, and until we start to get back the restaurant, retail, airline travel, tourist travel, business travel, it's going to be very difficult. However, the one thing with the new fund is that everything is being reset. The prices are being reset. Everything is, so you with a fresh fund, you've got an opportunity to go in on new numbers, on new understanding, on new
But
performance.
do you think they're being reset already?
Well, I don't think we're pulling the trigger yet. We've just or we're about to launch right now. And no, I think it's early yet, but the one thing is that I would tell you, everything is going to be reset at some point going. So if you have fresh powder, you have to be able to pick and choose what you can do. But I'll give you an example of opportunity in life, right? So every week there is the new movie, the largest grossing movie in Hollywood, right? So I think a year ago it was $434 million that the largest grossing movie did that week. So these two guys in New York who are both in the film industry went out knowing what they were doing and said they want to become the largest grossing movie of the week. This is back 3 weeks ago, okay? They wrote a movie for themselves. They called up some major actors who were all sitting home doing nothing, right? And sipping, sheltering in place. And they produced a 45-minute movie. They did it through Zoom. They submitted it to Hollywood. And the first thing they said was, this isn't a real movie. It's not. They said, look at the actors. Look what we did. So Hollywood, group goes, how did you do this? How did you get these people to do it? Well, they weren't doing anything. But here's the trick. What they did is they went in West Hampton, New York. They leased out a theater for 4 days. They took and sold all the theater tickets via Zoom, and they grossed a certain amount of money, and they submitted it as the largest grossing movie in America, $25,000. And guess what? They were the largest grossing movie in America for that week, standing next to Steven Spielberg and all the great names. They produced $25,000 of gross revenue virtually and did it. So when I'm saying that things are being reset, it's an extraordinary opportunity. And if one can unencumber themselves with some of the things that we have to do, but leave a little piece of time, effort, money, infrastructure to be able to look at new opportunities. When I say anything can be done, anything can be done. They have a $25,000 grossing movie. By the way, that was their goal because they spent $25,000 on the movie. So things like that can be happening. If you wanted to go in the rental car business today, I mean, Hertz is in bankruptcy. You would never be able to get and really penetrate that business. But today, I think almost anything's possible if you don't have a lot of baggage. So yes, is it right? Are things reset yet? No, but certainly there are things going on and moving on. I mean, we're on Zoom right now. Look where Zoom was 6 months ago. Look where it is today. So,
right.
There are good opportunities, and it's not coming about always they're coming about by problematic issues, but nonetheless, it doesn't mean you go out and do everything, but there are some things to look at.
It's interesting because, I'm a firm believer that a lot of the families back during the Great Recession were sort of sitting on the sidelines until things started to come out of that. And today, what I've noticed is that, that what happened back during the recession is still fresh on minds of family offices. They have dry powder. They're ready to take advantage of opportunities, just like you're talking about, Kent. And, they know that, that now is going to be a time to pounce, whether it's now or coming up in the near future. And with the long-term, aspect of families that they have with their investing, they can sort of ride out the storm, etc. Now, one of the questions that we had with, and Tom, David, has your family office considered investing in any VC funds who tend to have a counter-cyclical performance in difficult economical environments? David?
It's kind of out of my area. So we do have alternative investment team are looking at that, and we're typically not a VC fund or VC investor at this point. We're more private equity investor on that side of it. So I'm not very familiar with that. What's opportunity presented to the team. So
got it. What about you, Tom?
Yeah, I would say the same. I mean, we'd be very interested. I mean, it's certainly something that we've talked about internally. From a VC perspective, we've never had a big exposure to VC in general. And it's something that as we're going through our governance and reallocating kind of our investment policy, or not reallocating, but designing our investment policy. I mean, I would call it like just an old school ag family that that certainly would love to have more exposure to VC. We just I would be the first to tell you it's above my pay grade, and would certainly love to be introduced to just more efficient ways to get access to the asset class.
Now, Ken, you seem like you're more, and I could be wrong, but from what you say and what I know about you is that you seem to be along the lines of a lot of the family offices that believe in investing direct instead of funds. So on the VC side, do you have any VC funds? Is that something you'd consider or you've looked at in the past?
We have been more direct, yes. But with this, the Dignity cryptocurrency company we have, we're in the process through raising money, and I think we're creating an investment fund. And one of the things doing is that we're actually going to be giving dividends to the token holders. So it will treat this more as a stock company, if you will, than just a crypto company. But we will be doing third-party investing through that fund, which for us is a little bit more unique. We've done joint ventures with people, but we've had some, activity. In this particular case, we'll be looking to make investments very selectively and carefully, but we will be more passive than we've ever been before. But again, the complexion of what this fund is and how it's working will, by its nature, be a little bit more passive than not. So this will be a first for us, and we're ratcheting up to be able to do this.
Now, one of the things that I had a friend of mine, we were talking a couple of years ago, and about 75, at least on the real estate side, about 75% of the people or families want to go direct rather than go into funds. However, one of the thoughts are once we hit the next recession, or in this case, possibly the black swan, that a lot of families are going to realize it wasn't as easy as they thought in order to just go direct into investments. And, if they didn't choose the right operators or whatnot, then they could really run into some problems. And so that could end up having families sort of look more at funds to take advantage of that professional management, or, working with a family that maybe already has a platform in place, or a group that has some of that infrastructure to help them make those decisions. And, so that's something I think we're going to see what comes out of this whole COVID, depending on how long it goes. It looks like it's going more and more. Now, I will say this, is that on the distressed aspect for the hospitality, people are more apt to be going into funds because they know that you're going to have to move quicker based upon, opportunities that become available because of the stress that could be caused. And if you have to go to 10 different families to get approvals and they go through their process, you could easily miss those opportunities. So I think that's going to be something that we're going to be seeing, what direction that goes here in the future. Now, Tom, I'm going to ask you a question that you're going through this right now. And the question is that in today's climate, what advice would you give a current real estate investment group in converting to a family office? And you're establishing your family office, like you said, starting with governance. So let's start with you. What would be an advice you'd have for a group that wants to convert into a family office?
Well, I would start, you need to hire someone. I would say we've engaged a third-party consultant that's very experienced, as you know, DJ, in this capacity. I don't think we could do this without, having that outside consultant to help guide us through the process, because we haven't done it. I mean, we've been a family that's been together, as I mentioned, 5 generations, and we've got, 3 generations that are living. There's 27 of us. And to understand the importance of the governance, and most importantly, really the next generation, is really how do we educate our next generation from the Rodri family's perspective. I mean, it's, the range in age from 26 years old to 4. Having a third party that we've engaged has been instrumental. That person has been, certainly involved with families that have been multi-generational, or they've been families that have had a major exit with their operating business. All those things, I think it's just very important to start there. That's my suggestion. Is we interviewed a number of outside consultants to assist us, and we chose one. It was a process, but I think you really need to go through that diligence. And certainly consider me a resource. I'm happy to talk with anyone. And DJ, you've been great to me around, resources available for families that really want to organize themselves, because we've we always functioned as we had family meetings, but we were never truly, I think, as organized as we thought we were. And now we're getting to that point, and it's been a very positive experience.
So it sounds like then starting with that governance perspective, sort of putting in that foundation. David, is your family office, there's really a couple of different types of families that have offices. One is strictly a family office, and that's it. It's just, and a lot of times there'll be a major exit that happens, and they're just focusing on maintaining that wealth and then growing it for future generations, right? And then you also have offices that are combined with the business. And for example, the first patriarch that I worked with, there was a big real estate component where the wealth was created, but also he invested into oil and gas and solar parks, and had 3 people trading equities internally. And the way that I view a real family office is, are they investing their own capital out of a personal checkbook, or is it a business checkbook? Now, in the situation with my first patriarch, that one check was for everything. It was for the business. It was for personal. It was everything across the board. Do you guys have sort of like a wall in place between the actual family office and the other areas where they've got a professional like you overseeing a specific area, or is it really all in one?
So it's a family office. It's definitely set up separately from the operating company, like the Panda Restaurant Group. So that's a big operating business, 40,000 associates on that side. So the family office was set up at the very beginning, just completely separate. So I'm on this family office side and from day one. And so I've been working closely. And like I said, we started buying real estate for Panda. So I do have to work closely with our Panda real estate folks on that side to, own real estate instead of leasing. So, and I think at this point, the family office has grown to that. We have 50 people maybe on our side, because we're also acting as a developer for Panda, a preferred developer. So we do have teams of leasing and construction, entitlement, stuff like that. So so I think at this point it's more, I know Tom's family is trying to more engaging. I think at this point, we hire a consultant on the family office side to get Andrew and Peggy's daughters more involvement. So they are, one daughter is actually, it's on the operating company side of it. It's a chief of marketing. And the other 2 daughters are kind of more stay at home at this point. So I think we have consultants and, hired to kind of engage the family, the next generation, because Andrew and Peggy are the first generation starting the business. They're still fully engaged. The co-CEO, co-chairman's on the Panda Restaurant side of it. And also they are running the family office, meaning all the investments we actually presented to both of them to get that approval. So I think we are in a stage that we do need to get other family members, the daughters, engaged and involved. I think we are using consultants and trying to get that in place.
Got it. Ken, is your family office, it seems like there was a business that was sort of plugging along. You became a part of it. You helped grow it. How did you go about, what would you suggest for a real estate family, I guess you could say, created their wealth in real estate, and how they would go about setting up a family office?
Well, first of all, 25 years ago, the concept of the business of family businesses was not what it is today. Mm-hmm. Today, there is a full industry business of family businesses. So that creates a wealth of opportunity of consultants and people to really help what goes on. There's a determination that one has to make. You have an operating business in life, whether it's real estate or automobiles or whatever it is. And then you look, if you're the patriarch or the matriarch of that family business, of that business, they have to look at what's happening. What do you want to do with that? Typically people are giving it to their children, right? So in some way, shape, or form, there's going to be another generation at some point involved, whether it's because of death or because you're letting people in during your lifetime. And I think that the trick really is first of all, is to surround yourself with good advice, and there's plenty of that. And then you take a look at what a family office is versus a business. So you have a patriarch or matriarch, which typically I would call like a cult personality. That person had great or has great energy, great dynamic, very intelligent, does things, but they're sometimes, not always, corporately organized, not with all the governance and all these things that matriarch or patriarch would say bogs down the business. So you have to give that separate energy and separate time. And then you have to look, what is your legacy in life? You want to have a business, you want to sell it and distribute money, or do you want that business to going on to the next generations? In order for that to be successful, you have to get and shake that cult personality and then start to implement corporate governance and other forms of family governance into that, which takes time and effort, but helps to prolong the length of that company's operation, into multiple generations. And it doesn't happen by accident. It takes time, and it takes effort, and it takes lots of conversation. And then you transfer that cult personality into corporate governance, guidelines, and other things. And that's a process. And I know for my family, we did that in my generation. We started really in the mid 1980s. And we made some, then we had what they called the facilitator, because they didn't have that many. The idea of family businesses weren't as prevalent as they were today. So we started down that path, and it never ends, right? We just revised the family governance document because now we have fourth generation members that are anywhere from 17 years old to 42 years old. And it's important to bring them in and how to structure it. So we just about 4 years ago started a family assembly where rules and governance of how to invite everybody into a family assembly, not the business, how to educate them, what to do, and it's a full-time business, but it perpetuates the opportunity to pass businesses and family membership down.
You bring up a couple big points. First off, I want to make a note that what astonishes me is that you've got these patriarchs I've met in the past that created this business and they sold it for $3, $4, $5 billions of dollars. And they had systems, processes, controls. They had, how you do this or how you do that. And then it comes to the family and they don't have anything. Right. And it's like, you've already done this. Why aren't you not doing this with the family? And the other point I want to make too, is you get a lot of people, it's really, I've seen it happen over the last couple of years. A lot of people say, oh, I'm a family office, but it's really their business. And they're just trying to do it, position it from a marketing perspective. And the reality is that no, that's a business. And so if you are going to set up a family office, it has two components to it, what I consider the soft side and the hard side. The hard side is the investments, and it's specifically for the family. But then you have all the soft components, is everything you're talking about, Kent. Tom, what you're putting in place. David, what you guys have about how the money's being handled, the future generations. That's really what the family office is about. It's how do we maintain the wealth that we had. The first thing, if you're hired by a family office, is there's 3 guidelines that you have to co-abide, which is don't lose money, and don't lose money, right? Because you may never get that money back again to the extent that you've created it. Next is to grow it. And third is, how are you going to deal with all the family dynamics? I mean, some of these real multifamily offices address some of these situations. I asked you to have a psychiatrist on staff because sometimes the dynamics within the family are so out of whack that you're having to deal with all the emotional components. I mean, if you have brothers and sisters, you're dealing with issues and there's fights and everything else, but then add hundreds of millions of dollars on top of that, and it's a whole different.
Well, that's why you have to separate out that process.
Exactly.
And I will tell you, one thing becomes evident, like whether it's a psychiatrist, or a facilitator, whatever it is, you need third-party objectiveness.
Yes.
But what we found out in going through this process is, wow, we had a lot in common. We had the same grandparents, we had the same aunts, uncles, whatever. We're all first cousins in my third generation. We all grew up in San Francisco. We had so much in common, and I think, you need to step back a moment, and third-party objectivity helps that to see, 99% of everything going on, you guys have in common. You're going to rise and fall together. It's the 1 or 2% that has slight differences, and you have to work through those issues. And they don't come about by a CFO sitting down with you, and they don't come about necessarily by an attorney alone. It takes somebody who is schooled in the art and industry of family businesses, and you have to give it time, attention, and some money. And it works. And ultimately, what's the legacy that the patriarch or matriarch wants? You want continuity of that family business? Do you want to splinter it? Because it doesn't happen by accident. And luckily, in today's world, there are the people like you, DJ, and others that are available out there that are very valuable to help. And there's some that just say, I'm going to sell the business and distribute out the money, and God bless everybody. Well, that's okay too. But if you want a cohesive family, it doesn't, it's like marriage. You don't get married and everything's perfect, right? You have to work at it. Well, a family has to work together to do things. And it's the most rewarding of all, but it's also a lot of work.
I think too, is that as you get future generations, and David, I think I could be wrong. However, knowing millennials and younger generations than the patriarchs and matriarchs, that these meetings that you're having for them to get approval right now may very well change when you start getting those future generations with the mindset, which I'm seeing. One mindset is that it's not about the profit as much as it's about saving the world, where if you go to a patriarch that I've experienced, is that they want that higher rate of return. Forget about saving the world, where you get the younger generations like, oh, we'll take less, but we want to save the world. So I'm sure you've probably experienced some of that as well, right?
Yeah, definitely. I mean, like I said, we're still trying to engage the next generation. I know we had a few meetings. They came in, and we have bigger meetings with the family, like 2 generations. I totally agree that they just like they grew up differently, right? One grew up like in Asia, in China. They migrate to US. They start their first business, like Andrew started with his dad at 25 years old. So it's completely different mindset when the second generation grew up in a very successful business family, right? So their focus, their life experience were very, very different. So I totally agree. Next time when we're sitting, if the second generation going to be the one we report to or getting approval, I think the dynamic will completely change.
And Tom, if I understand correctly, I think we've talked about it before, is that, even sitting down with your brothers or whatnot, you've sort of realized either you guys are really on the same page, or there's some differential thinking between the family members. Is that right?
Yeah, and we've been fortunate. I mean, I think to Kent's point, we've discovered more similarities in terms of just fundamentally how we think about things, and certainly what we've recognized. Again, to Kent's point, is how hard the work is. I have 4 older brothers, and so us 5 really, as we kind of take over the governance of the family, is the importance of educating the next generation so that they understand that you got to treat the wealth like it's first generation, and it's a responsibility, and there's real purpose in that, right? So the better we can communicate to the next gen that this is a great thing. It's a great to be responsible for this and to carry on this legacy, from my grandparents, my great grandparents, forward. That's what's important, and that's something that I think, while we thought we were kind of handling that, in a way over the last decades of family meetings that we've done, but now having an outside consultant, it's really opened our eyes to, we've just got to get a tighter grip on this next generation to really, really help grow them into these roles. And it's fun. It's a good process. It's hard. There's some, you get into some difficult conversations. But we're fortunate, I think, in the regard that our baseline is all fairly similar in terms of how we think about things.
Got it. Now, if anybody has a question, we're going to be finishing up here pretty soon. So please, a question to anybody on the panel, and we'll make sure we get that answered for you. So Tom, I'm going to go around here and saying we're at a situation we don't know if COVID's going to stop and we get a vaccine. It could be a year from now. it could honestly be longer. We also have a presidential election that's coming up, which is going to be quite interesting and could have impact. So what is your plans, your family's plans, your business plan going forward with what you know today on how you're going to go about what may be in front of you over the next 6 to 12 months?
Well, I think I'll leave it, kind of, this is a big part of our focus. If we look at just investable capital that you've got available, and if you look at, what's been going on with the Fed and the program of, buying into investment grade high yield, and that's keeping yields down that you can get in the public markets. If you're thinking about just ways to protect capital, and you say, well, wow, my real yields are in the, 0.5%, 2%. For us, we look straight to cash flow and say, well, where can we buy cash flow? Where can we go? And that's why we continue to be fairly bullish on multifamily. Not necessarily new build because of construction risk. I've got over 15 years of experience in land development and home building for sale, and that's a tough industry. It's just tough taking that construction risk. But I think it's, it would be on anything that can generate cash is a place that you want to be, because we're not seeing it. If I go back to my grandfather just buying muni bonds and clipping coupon, well, look at the muni bond market now. I mean, we just stay focused on, areas that generate good, solid cash flow, and focus on it from a long-term perspective.
David, how about you?
Almost identical, long-term cash flow, and that's how the CFT, so we view long-term partnership. We hold long-term real estate and looking for the cash flow generation. So that's what we're looking for.
Ken.
Very similar. I think asset preservation is important, and what we've proformed for ourselves as a family is how do we sustain a certain level of distributions, and then balance that. So we have to have growing cash flow, and we buy cash flow, and or we create the cash flow. So I think that's the most important thing. I think at this point, like David, in some respects, I think my family has been looking inwards mostly to preserve what we have and make sure that we're in a safe, good, strong position, and our balance sheet remains proper and strong. And so we are looking at selective new opportunities, but I don't think we've marched forward like that. I think we're really focused on what we have, and to try to complete. We had a couple of big projects going on, so we wanted to make sure that we've completed them and done that. From my personal point of view, I've tried to shift some assets, both human resources assets and others, to look opportunistically without any looking at what I have. Right, so it's pure opportunity, and if I didn't create that separate and apart from what I have, I would be forever in my own business and operating companies that I have right now, because there's more work to be done than I could ever do in my whole life. So you have to be very, if I want to take advantage of something, you have to be very purposeful in that, and so I've created that to do that, and that's the only way I think that there can be some new opportunities looked at without, leaving my existing business with not the proper energy and focus.
Marina, I'm gonna send to you in a minute, but I'm just gonna give my response, and then we'll pass it over to you. So from our perspective, we're looking at opportunistic plays. That's why we partnered up with who we feel is probably the best in the industry to look at distressed hospitality opportunities. We definitely see that cash flowing for sure. I do think that a lot of the fundamentals will remain the same on the multifamily side. In fact, you might even get more people moving to areas that have a better cost of living, quality of life. So that is a lot of the secondary markets. We're seeing a lot of people move out of New York. 6 months ago, you couldn't sell a house in Connecticut. Now it's hard to find one, and there's multiple bids on there. There's also one other area that's really come relevant to me, and it's a new phrase, a new classification of retail that I should probably trademark, and it's called essential retail. I think that's an area that's extremely interesting. And what I mean by that is, what hasn't been affected during this COVID, what is also considered recession proof. You're looking at the pharmaceuticals like CVS, Walgreens, right? You're looking at dialysis centers like DaVinci, right? And what other areas in that retail sector, marijuana? I mean, that's an essential. And as those brands grow out, I think there's a huge opportunity there as long as you're okay with that industry that you're part of. So I think it's a matter of looking at properties going forward as, what can weather the storms if we have a black swan, and what also, can handle a recession as well. So I think there's a lot of opportunities. There's going to continue to be opportunities the longer this COVID happens. And so as families, I think it's a matter to be ready and take advantage of that. Marina.
Thank you so much, DJ. Thank you, everyone. Kent, Tom, David, wonderful job. Great discussion. A copy of this, you will receive an email with a link to download and save the recording. We have a lot of other live experiences scheduled for the next few events and weeks. Again, thank you so much to the whole panel. And until next time, just stay safe, healthy, and have a great rest of the day from the whole iGlobal Forum team.
And thank you to our panelists today. I mean, these are some of the industry best, so I'm glad they were able to join us. And thanks to iGlobal, because I think you guys pick up a lot of relevant information and webinars with what you're doing here today. And so I think it's definitely, you guys are leading in that area.
Thank you. Thank you so much,
you
all
both.
of you. And we'll see you soon.
Thank
Have
you.
a good
Thanks.
one.
Tom,
Thank
too.
you.
David, thanks. See you guys.
Thank you.